Yo, what is going on, guys? Welcome back to the Journey Podcast. Today, we have a special guest, Justin Green from Assist FP. He is the owner of a financial planning firm. I'm actually out in, where are you from again? You're out in Texas or on the East Coast?
No, so yeah, I'm in Massachusetts, and
There you
my
go.
fiance is a travel nurse, so we bounce around the United States pretty frequently.
Awesome. Well, last week, Justin had the honor, or I was honored to be on Justin's podcast to talk about my story with personal trainers. And I thought, it would be great for the listeners on this podcast to learn a little bit more about financial planning, cash management, because a lot of you guys are just getting started with business. And one of the biggest things you guys, or one of the best skills you guys can possibly have when it comes to owning your own business is just understanding money, how it works, understanding how to best be prepared for, the future, for savings, for retirement. So wanted to bring Justin on to, go over the basics and go over the intro. And Justin, without further ado, I would love for you to give yourself a quick little intro, a little backstory as to who you are, what you do, how you got into the position of owning your own firm, and what your podcast is all about as well.
Awesome. Thanks so much for having me on, Zach. I know we had a lot of fun last week recording, so it's a pleasure being on here and getting to talk with your audience as well. So like Zach was saying, I'm Justin Green. I have a financial planning firm. I'm a certified financial planner, and I work with online fitness coaches and fitness entrepreneurs and their businesses. And so I have a kind of a traditional path where I worked at a retirement planning firm for a couple of years, about 4 years. And I got kind of bored with it. I was working with older individuals like retirement, Social Security, et cetera. And it just didn't vibe with me well. I'm a younger individual. I'm very entrepreneurial. I'm very growth minded. And so I wanted to work with people who had those same characteristics. And I'm really into fitness as well. I got into fitness like late in high school, probably like junior year, and I haven't stopped since then. So those are kind of my two passions, finance and fitness. And so finally, when I decided to go out, launch my own firm, Assist FP, I kind of launched it with the intent of working with fitness coaches, but I didn't like go all in right away because I was just kind of nervous to niche that soon with turning down 99.9% of the population when I had 0 clients to start. But pretty early on, I just started networking within your community and just meeting all these awesome people. And I was like, yeah, no, these are my people. I'm going all in. And so I kind of pivoted a couple months after launching the firm. And I've been kind of focused on working with online fitness coaches since then. And then a couple of months ago, I did launch a podcast. So it's called Dollars and Dumbbells. And Zach's episode will be coming out here in a couple of weeks. But basically, it's just an opportunity for fitness coaches, business coaches, pretty much anyone who is serving fitness coaches to come on, share their story, share what they're doing to help other fitness coaches, and just give fitness coaches a platform to learn from each other. Because I know there's a lot of great coaches out there doing a lot of great work, and there's a lot of clients out there that need help. So it's not like you guys are fighting with each other for clients. So learning from each other's stories and what works, what doesn't work, I think is a really good opportunity to just have people on there to share their stories.
Absolutely, man. I love it. I love that you found your way in the fitness community because it's one of those things where once you find your way in, you one person knows another person knows another person. Everyone is connected in here. So I love that.
For sure.
Question for you. How long have you had your firm and what exactly do you do for fitness coaches?
Yeah, for sure. So I actually launched about 10 months ago. So March 23rd, 2021. And what do I do? So I focus mostly on cash flow, taxes, and saving for the future. I don't actually do tax prep. So like a CPA would or an enrolled agent would do tax prep. You don't actually have to have those to do the tax prep, but those are common designations for doing the tax prep. And I don't do the bookkeeping either. Those are things that I'm considering in the future. But as of right now, basically, a coach would sign up to work with me if they're don't have the time to do a lot of the management on their own. Like maybe someone's helping them with the taxes and the bookkeeping, but they're just not sure where their money's going. Like it's coming in and out, but it's going out quicker than it's coming in, right? It's so easy to do that when you don't have the time to look at it. They want to understand more of some of the metrics that they should be measuring in their business and both in their personal life. And then they want to figure out like, so when someone's doing your taxes, they're not really doing proactive tax planning. They're just kind of taking what you're giving them and then they're saying, okay, here's what you owe. Whereas I have the full picture. I can look at your whole like financial situation and do some proactive tax planning. So that way you're paying lower tax bill, come tax time, rather than just like looking at what happened last year. And then once coaches have kind of gotten their footing under them, I mean, a lot of coaches blow up sooner than they think. They start making money very quickly. If they're knowledgeable and if they're relatable, like people just attract to them. So all of a sudden they're making, 5, 10, 15, 20K a month. And now they've got more money than they've ever had before, and they don't know what to do with it. So sometimes you'll see like coaches will be like, I know I should be saving. So I've got like, a bunch of money sitting in the bank. Like, I don't really know what to do with it. Can you help me with that? So I can do investment management as well at my firm, and I can help out with that.
Awesome. I love that. Yeah, I think I'm not sure if you knew this about me, but when I was first getting started my entrepreneur journey, the first thing I ever discovered was investing. And so investing was like the number one thing. I was like, I want to be an investor. I want to invest my money. And then everything from there was kind of like the cart before the horse. And I go, wait, I don't have any money. I need to get money. Oh, I need to start a business. Okay. Now, and then everything kind of trickled into investing. And so I feel like when I started making money in my business, I knew exactly what to do with it. I mean, even when I was bussing tables, I was spending part of my paycheck on, building up my investing portfolio. But for someone who is just getting started, let's say that they're just graduating from college and they've never taken a finance class before, and they've never, had to manage their money before, and now they're making, 5 to 10K a month. What are some things that they should look out for when they start making money that will best prepare them for, a better future, or, any bumps in the road or anything like that?
For sure. Yeah, no, one great point you just said, kind of putting the cart before the horse. Like, a lot of times, like I like to call it, you need to earn the right to invest. So you need to take care of a lot of the basics first. It's kind of like in fitness, right? Like you need to learn proper form before you really start getting into big compound movements or like fancy exercises. You really need to kind of earn your right to invest. Investing is the best way to grow your money long term. But like if you just hop into it, then it's not going to work. So you need to establish some good practices before then. And some of that is really just managing your cash flow. So understanding like what's coming in and out of the business, what are you spending, and do you need to spend that much? And then a big one I see with coaches is like early on, they don't separate their personal and their business expenses. And that is huge. Like that's, if you just take one thing away from this, separate your business and personal expenses. So what does that mean? Like, don't use the same credit card for, business coaching as you do getting groceries and gas and etc. Like separate those. Either get a business credit card or get a personal credit card that's solely specifically used for the business, and then make sure you have like a business bank account set up to receive the income, right? You don't want to just have like everything coming into this like personal checking account. And a lot of coaches have an LLC. So if you have an LLC, you can actually put your LLC at risk, like the status, by commingling your accounts. So it's really important if you have an LLC, but it's also just really good practice, even if you don't have an LLC. That's step one, because then you can actually track your income, you can track your revenue, and you'll be a lot more organized for tax season, et cetera. But once you start reducing your tax bill and knowing what's coming in and out, then you can figure out, hey, what do I have left over to maybe put into investment accounts?
Dude, so that was actually my problem too. It took me a very long time to start investing in mentors and starting getting in business, because all of my money, instead of going into myself first, was going into index funds. And while they were growing, they just weren't growing at the rate I needed them to really get my business off the ground. Sure. But just to kind of recap, just so people kind of understand, first step is to separate business expenses and personal expenses. And so the best way to do that is just to segment different cards for each kind of expenses, correct?
Yeah, cards or accounts. A lot of people like to use credit cards just for the rewards and stuff. But it can be just a regular checking bank account as well.
Awesome. And just for the listeners, just to kind of give you guys what this would look like. For myself personally, I have a business bank account, which I opened up under my LLC. So everything that I make from my business, all the income produced from PTBI and all my other side businesses, all that income goes directly into my business bank account. And then I have a business credit card. So everything that I buy on the business, so advertising, let's say gym clothes or a computer or anything that is for my business goes onto the business bank account or the business credit card. That way I have income and expenses easily segmented on their own platforms. And then I have a personal bank account, which I just siphon money from my business bank account, siphon it into my personal bank account. And anything like going out to dinner or buy myself like personal clothes or groceries or anything, that stuff comes out of the personal account. So that way everything is nice and neat. A question for you, Justin. Why is that even important to segment all of your payments or all of your expenses and all of your income?
Yeah, for sure. So, I mean, one like very, I guess maybe not obvious reason, but like think of all the spending you do on a regular basis in your personal life. You get groceries, you get gas, you get clothes, you get drinks, you get food. Like if you then at the end of the year, if you haven't separated this at the end of the year when tax time comes and you haven't been paying attention, and now you've got to search through like hundreds and hundreds of transactions to figure out like, shoot, what was a business expense and what wasn't, right? And then you're going to miss things. And when you miss things, then you're not going to be able to deduct them. So you're going to pay a higher tax bill than realistically you should if you were actually organized. Now, with an LLC, you have to separate them. Like it's just, that's one of the rules to be considered a separate entity, which is what an LLC is. So for that, it's like, that's just the rule. So you have to do it. I mean, it's a good practice no matter what, and it'll keep you more organized. But you have to do it for an LLC or else you could risk losing the status. And then the reason people get an LLC is actually for liability protection. You know, a lot of times people confuse it and think it's for tax reasons. Down the road, there are tax benefits, but an actual LLC is set up just for liability purposes. And then the way you choose to have the LLC tax, which is, you kind of talked about that on your podcast a couple of weeks ago, so we don't really need to go into that. But that's a different thing. So you don't want to lose the liability protection, and you can lose that if a lawyer were to show like actually your accounts were combined. So it's not a separate entity. I'm not a lawyer, so I don't know all the rules around that, but I do know that's like 101 for having an LLC, like separate the business and personal expenses.
Gotcha. So that leads me to a good question next. First, I'd love to dive into like an LLC. You know, what exactly is an LLC? You said it's for liability, but like, how is it actually used? Like, in what cases would it be used other than just opening up a business bank account? And then the second question I have is, a lot of people are scared of taxes. I know for myself, I was like scared shitless of like taxes because I didn't really know.
They suck.
Like, yeah,
everyone hates taxes.
It's such a big boy thing that I was like really nervous about it. But more importantly, I was more nervous about messing up and getting in trouble. Mm-hmm. So what are some of the common mistakes people make when it comes to their taxes that gets them in trouble, and how can people prevent those mistakes?
For sure. So, all right, let's back it up. So LLC, honestly, an LLC is pretty simple. People overcomplicate LLCs. You know, it is when you're starting a business, and a lot of times it does make sense to just kind of start up with an LLC. Now, where you're operating out of, like what state, can really depend on like the administrative cost. So like I know here in Massachusetts, it's like $500 a year for an LLC. So like it's not cheap. Some states are like $50, right? So the barrier in those states is much lower. But what an LLC does is it actually separates the liability risk from your own personal situation. So just to kind of put an example, say, you know, Zach, before you open your business, you've got a house, you've got a car, and you got some other stuff there. And then you go and you just start training people. You don't open an LLC. So you have no liability protection. If someone were to sue you because you gave them an exercise and then they shattered their back and now they can't work and they want to sue you, they're suing Zach Colburn. They're suing you for your home, your car, etc. Now, when you operate as an LLC, when you open that LLC and you follow the guidelines, you now have the liability protections, literally the name, Limited Liability Corporation. So now if someone were to, same situation, sue you, they're suing the company, right? They can't sue Zach. They can't sue Zach for his house, his car, his family, everything else. You know what I mean? Like they're suing the company. So when you form an LLC, you are taking a lot of liability risk off the table right away.
Yeah. I would say it took me a long time to get my business registered as an LLC just because I lived in California, and it's pretty expensive here. I think it was $1,100 to get it registered.
Dang.
Yeah, $300 to get it registered, and then $800 for the like tax bill or whatever they had, the franchise bill or whatever. That's the yearly thing. And so I was like, I don't even have anything to my name anyway. So like, if someone were to sue me, yeah, they wouldn't sue anything. But once I had like 10 G's in the bank account, I'm like, all right, this makes sense to get an LLC now. Now I have something to protect. I'll get an LLC. Let's go into the next question about. Oh, go ahead.
I want to expand on that a little bit because you were talking about taxes with that. So like when you do become an LLC, because this is a common misconception that gets thrown around a lot. When you become an LLC, you then have the choice to either be taxed as a sole proprietor, assuming you're an individual. If you're a partnership, it gets a little more complicated. But if you're an individual, you can either be taxed as a sole proprietor or as an S corporation. And they're two different things, but they're both still considered an LLC. And when you do it as a sole proprietor, it's like the same thing as if you're just in like a single person running a business, right? Like the money just all flows directly to you. You file a personal tax return. There's really not a whole lot of additional complexities. But when you do a sole proprietorship, now you've like created a business return that you have to file. And there is a way, and I'm not going to get into this because it's way too deep into the weeds, but there is a way to save on self-employment taxes. So a lot of times you'll hear people pitching this like myth to like go S corp like right away. But reality is there's a lot of administrative costs to being an S corp. You have to pay like a payroll company. You have to pay yourself a reasonable salary based on IRS standards. So, I mean, if you're not making enough money to do that, like that's not going to work. So it's a long-term strategy that does make sense for a lot of coaches eventually. But like when you hear people on social media just pitching the S corp, just know that there are some costs associated with that to get the advantage. So there's almost a break-even point. If you're not making, and this isn't specific advice, you got to check with your tax professional, but if you're not making like 7K plus a month consistently, you're probably not at a point where it's going to make sense yet.
So I heard a rule of thumb that was said, once you're making 15K consistently, get an S corp.
15K a month?
Yeah, that's what I heard.
I mean, every situation's different, but that's pretty conservative. Because 15K a month's like, 180,000 a year. So you just have to pay yourself a reasonable salary. And that could be anywhere from like 50 to 70K, depending on your location, geographic, your credentials, the size of the business, etc. Like, I mean, it is complicated figuring that out, but you would want to start thinking about it sooner than that, in my opinion.
Gotcha. That's good. That's good advice. But the next question I had was, people's fears with taxes. They're afraid that they're going to get in trouble. Someone's going to come knock on the door and take them away from their families. What are the common mistakes that people get in trouble for, and how can people prevent them?
Yeah. So one of the common mistakes is not paying them. You're going to get in trouble for that. You can piss off a lot of people in life. I don't recommend the IRS be one of them. Now, obviously not paying them will get you in trouble, but what a lot of people do is they don't set the money aside in advance. And so then they get themselves in a position where, yeah, they're probably going to pay it, but it's like, they're going to have to find the money, right? Like now they've really got to hustle and work hard because they have no money in their accounts because everything that's coming in is getting spent and they never plan for it, right? So, one thing I would say there is plan in advance. So every month, I actually use, I don't know if you're familiar with this, the Profit First system, but have you ever heard of it?
Yeah, that's what I follow too.
Oh, perfect. Yeah. So I'm a big fan of it. And in that system, they basically have you set aside like 25% upfront in taxes. And you can adjust that number based on your actual business and your revenue, because you may owe more than that, you may owe less. But basically what you're doing is like once a month looking at your revenue and then setting aside those into buckets. And one of the buckets would be tax. So I would recommend doing that. And then when the time comes to pay your tax, it's there. You don't have to worry about it, because if you're, not paying your quarterly estimated taxes correctly, or if you're paying on a very like conservative basis, but your business has grown a lot this year and you're actually going to owe more, then the money's there to pay your taxes, right? It's just a lot of unnecessary stress and anxiety that people add on to themselves. Like, we know it's a guarantee you're going to have to pay taxes, so just plan in advance for it.
Yeah, absolutely. I think that's the biggest rule of thumb too, is just know you're going to owe taxes. And so as long as you're saving, you're in the green light. And as long as go ahead.
I was going to say, I even very early on, I tell people to do this, right? Because now we're just forming a habit. Even if you don't make enough money in year one where you actually pay a significant tax bill, we've formed the habit. You are now in the habit of paying yourself the 25% for taxes, and you're going to continue to do that as your income grows, right? Really, I love getting things automated in a system and just enforce good habits from the beginning.
Yeah, that leads me to my next question. How do you recommend people now? Let's say that they, are using different accounts to track their income and expenses. How would you recommend they actually keep track and keep organized? What systems would you recommend, or what exercises would you recommend for people to start practicing the habit of saving money and saving for taxes?
Yeah, good question. So I think you're talking like software, right? Is that
Software, okay, even like Excel sheets, like
yeah. So
what are good practices?
Very cool. Yeah, no, good question. Very basic would be Excel or Google spreadsheets. You're probably using a payment processor where you can export like the transactions. So for the revenue, you can put that into an Excel spreadsheet and then also export your expenses. When you have the accounts separated, it makes it a lot easier to keep that organized. Now, as you kind of grow as a business, Excel or Google Sheets is probably going to get a little cumbersome for you. You're going to probably want to move on to a software such as like Quickbooks. I think Wave is like a free one that's out there. There's FreshBooks, a couple different services that allow you to kind of do it on your own for 20, $30 to use their software. And what happens is they can set up some automations where, like, if you have a recurring expense, it's just going to automatically categorize it on an ongoing basis. It makes it your job a little bit easier, takes some of the time off your hands. As you really start to grow as a business owner, you should probably look at outsourcing the bookkeeping, because it's just the cost of what it would be to outsource it compared to the cost of like the value of your time. There's a big gap there. So as you really grow to maybe like, I don't know, if you're getting close to like 10K a month, like it's probably time to like really focus on the business and outsource some of that. And if you're going to do that, look at like a CPA or an enrolled agent, a CPA, a local CPA firm. There's a couple virtual firms that they specialize working with online coaches as well. But that's where I think there was two parts to this question. I forget the second part, but that's where I would focus on. Like those are the steps, like really basic, start in a spreadsheet, move to a software, kind of doing it on your own. And then at some point you should probably just get professional help.
Okay, awesome. So what would you say, like with professional help? Because I'm probably right there. Honestly, I should probably be looking into professional help because I manage all of my books on my own.
Really?
I do all my payroll. I process all the payments manually. Yeah, I do everything by hand.
So are you an S Corp then?
I am an S Corp. Yeah.
Yeah. Okay. What do you use for payroll?
I use Gusto for myself,
Nice.
and then I use TransferWise. Yeah, I use TransferWise for all of my contractors.
Gotcha. Cool. Yeah, Gusto is a great system. They make it pretty easy to use.
Awesome. So then what would you say the difference is between, like bookkeeping, like what would a bookkeeper do versus like a financial planner? And I do want to start moving away from saving and start talking about investing. So we can make that transition now with the answer to this question.
Yeah, no, that's a pretty natural transition. So bookkeeping is really just tracking your income and expenses. That's it. That's all they're doing. They're categorizing, maybe giving you some reports to kind of measure your cash flow, different expense ratios, stuff like that. But as a financial planner, we're taking that and we're diving in deeper. We are looking at taxes and then investing, right? And so investing is kind of the third step on it. You really have to take care of the cash flow because you have no money to invest if you don't have your cash flow in order. 2, you need to make sure you're paying your taxes. That's step 1 or step 2. And then step 3 is, all right, now you've got extra cash on hand. Let's look at investing, right? And investing for me is a very long-term focus. And you kind of alluded to this earlier. You started investing like really early on, but you realize like the returns aren't there right away in index funds, right? But long-term, they're pretty solid over a long period of time. You're gonna probably average out with like low-cost index funds. You're gonna average out to probably like 6 to 8% per year over the long term. But if you're trying to like make money overnight, then that's not the type of investing that you're looking for. You're going to want to invest back into yourself, into your business, etc. So the type of investing I do with clients is more of a long-term focus.
Okay. Well, let's talk about what that looks like. Let's say that's, we have, because I do have coaches that are now in the 15, 20K a month mark. And, that's more than enough. That's more than enough money that people need. They definitely have room to put some money away for the long term. So what would a crash course 101 of investing look like for someone who's now making more money than they know what to do with? They can save $2,000, $3,000, $4,000 a month and put it into, long-term investments. What does that look like?
So first step is, as a business owner, the tax code's our friend, right? And you're like, dude, we're talking about investing. Why are you talking about taxes again? Because we have availability. So when you're like a regular employee, you have a 401k, right? We don't technically have that. But what we do have is what's called an individual 401k. But before that, like more basic account is called a SEP IRA. And then we also have like traditional and Roth IRAs as well. Those accounts will allow you to invest your money, but then also reduce your taxable income. And that's really important for a business owner because we pay pretty high taxes. We've got the self-employment tax, which is about 15.3% that used to get covered by an employer. But when you're doing it your own, you are the employer and you are the employee. So you pay the full 15.3%. And then you're going to pay federal and state income taxes, right? So if you're ready to start saving, investing money, a good place to look is these IRA accounts to allow you to reduce your taxable income, because now you've accomplished two goals, right? You've paid less in taxes, which gives you more money to now invest. And then you've also created a long-term retirement account, and you can invest those retirement accounts.
That's awesome.
The other thing I like to emphasize is, because if you heard that, you might think like, well, like IRAs have penalties if you take money out. Like that's true. Those are long-term accounts. They have the benefit of reducing your taxable income. Some of the drawbacks is they're not very flexible. You may be able to take a loan out of certain accounts, but like, for the most part, they're not very flexible, right? I do emphasize flexibility a lot with coaches because you're entrepreneurs, you're building your businesses, like you never really know what's going to happen, right? So you don't want everything locked up. So there is finding a balance between these like long-term accounts that you do need, but maybe you don't fully max those out. And maybe you put a little bit over here in just like a regular, what they call like a taxable brokerage account. And sometimes you kind of go a little bit more conservative with that account because it's almost like a backup fund. Should you pursue real estate, business opportunities, etc. I see that a lot with coaches. They want to try new things once their business is successful.
Gotcha. Awesome. So what would a good beginner strategy be? Would you recommend that coaches open up 3 different accounts and have 3 different methods of investing? Would you recommend they open up one account? And if so, what account would that be? And for how long? How would you guide someone who's just getting started?
So if you're just getting started and you're not like making the like 15K a month, like we were talking about earlier, let's talk about someone who's like really just now able to save maybe like $100, $200 a month. Like you probably want to look at either a traditional IRA or a Roth IRA. Those two accounts are similar. The main difference is a traditional IRA will reduce your taxable income. And then when you take that money out in the future, you will pay taxes then. So you're basically trying to make a bet on this. Like, will my tax rate be lower now or will it be lower in the future, right? Because on the flip side, you could invest in a Roth IRA. In a Roth IRA, you'll actually pay the taxes now. So if you feel like you're in a low tax bracket now, you pay the taxes now, and then it goes in the Roth IRA and it grows tax-free. And then when you withdraw it from that account, it's not taxed. So that's the benefit of the Roth, and that's the difference between a traditional IRA and a Roth. Now, the reason those are first step is because they're very easy to access, and but they only have a $6,000 annual limit, right? So if you are looking to invest more than that, then, and they have income limits, which you're probably not hitting yet. So that's why we can introduce them here. But if you're looking to invest more than 6,000, then that's when you have to start to look at other accounts.
Gotcha. See, my thought process is like, why wouldn't I expect to be in a higher tax bracket when I'm older? I'm like, I would only want to be making more and more money as my business grows. And
in theory, you probably would be.
Yeah.
In theory, you probably would be. But for me to say that using generalities, it's tough. But in theory, the Roth would probably make a lot of sense for a lot of your students being younger coaches. Like, you're right. They're going to grow the business and they're probably going to be in a much higher tax bracket later on in life.
Yeah. And yeah, that's great. So with the Roth and with the traditional IRA, or it's IRA, correct? That's the right term. Mm-hmm. How do these how do they invest your money? Are they putting them into index funds? Are there's
So
people
you
actually
invest it.
managing them?
Oh, so you can either invest it yourself, like you can manage it yourself. I can manage it. Other advisors can manage it. You can use like a Vanguard, they can manage it. You can use like robo advisors. Some people use those to manage it, but you can, for the most part, you can invest in almost any index fund, any ETF, a lot of managed funds. So you can invest in the stock market, you can invest in real estate funds, bond funds. You really get to choose how you invest it.
Gotcha. And then so if someone is going to be starting to invest and they're like, okay, now there's this whole new world of information for me to consume, where would you recommend them going to learn about investing and learning about tax strategies and learning about, saving their money? What resources would you recommend?
Yeah, that's a good question.
You can plug yourself here too, if you want.
Now, to be honest with you, I'm not investment heavy, so I'm not the best resource. If you really want to deep dive on investments, you want to look into people like, Warren Buffett, who's like old school, but, really good, or like Josh Brown. He goes by the name like Reform Broker. He's on CNBC often. He's a financial advisor, puts out a lot of content. I'm trying to think of what other resources. I'm going to come back to that if I think of something, but basically, I'll tell you my strategy is I'm a very like conservative, low cost, passive index fund guy. And the reason is I think it's very, very hard to beat the market over the long term. We've been in this crazy environment over the last couple of years where people do make crazy money in the short term, but it's not guaranteed. You know what I mean? Like there's a lot of risk involved. And there's a lot of survivorship bias. We hear all the success stories of people day trading or crypto, et cetera, but you never hear about the people who like lost it all. You know what I mean? They're out there because it's a zero sum game in that situation. Like for you to win, someone's going to lose. Kind of, not exactly, but kind of, you know what I mean? Like, So there's always two people on the side of a trade, right? For every time you buy, there's someone selling and vice versa. So long-term index funds, and basically what that means is an index fund just tracks a market. So for example, an S&P 500, that is the 500 largest companies in the United States. And so an index fund, an S&P 500 index fund would basically just be one fund you buy that just holds all 500 companies. And they might weight it a little differently than, Vanguard's S&P 500 fund might be weighted a little differently than say like State Street's S&P 500 fund. But essentially, you're just buying the entire S&P 500 when you do that.
Yeah, I will say one of the best books I read on actually there's three. I feel like this is like a 3-category game. One is learning how to save. The second is tax. And then the third is investing. So the best book that I read on savings is this book called The Richest Man of Babylon. It's a pretty old school book. It's a lot of theory, but it honestly just taught me that the value of even just saving, like, if I get paid $100, how valuable it is for me to save just $10 and just, continue saving, 10% of my income. So that was a big one. The second one is Tax-Free Wealth by Tom Wheelwright, I think. That one was like taxes for dummies. I was like, oh my God, this finally makes sense. And then the third one is Money Mastered the Game by Tony Robbins. Have you read that one?
Yeah.
Okay.
Yeah. So actually, no, it's funny you bring that one up because actually that's a good one. I don't know why I didn't think of that. That's actually like one of the books that kind of sparked my interest in personal finance. Now there's a lot knowing what I know now that I don't agree with in that book, but it was enough to like light this fire where I wanted to learn more. I think I read it I read it when it first came out. I don't remember. It's been a while now, but I like Tony Robbins because how can you not watch that guy and want to run through a wall, right?
Yeah.
Like he gets you amped up. And so I saw the book came out, Master Money, and so I read it, and that actually sparked the interest I had. I'd already been into personal finance, but that kind of was like I just got really amped up after reading that, and I wanted to learn more and more and more. And so I started diving in. And I wanted to add, so in the, Richest Man of Babylon, that's a good book. I think there's like almost like a fourth category, or you can add it in with like the first one, the cash flow. And it's like a money mindset, right? So like Psychology of Money by Morgan Housel is really good.
That I freaking love that book.
Yeah, that's really good.
That
I got
one's
it back here.
fantastic.
Yeah, no, that's really good. Another one is what's it called? The Millionaire Next Door by Thomas Stanley.
Mm,
That's a really good one because basically that's just showing you how like millionaires don't live the way you think millionaires live. Like everyone, when they think the term millionaire, they think of like flashy, sexy, like, you know, living this like high life. Reality is like the dude walking down the street with like torn up jeans probably has more money than the dude with the fancy car. You know what I mean? Like that book really opens your eyes to that mindset, and kind of gets you in a better mindset to save and spend less. So I like to add those in there. And then taxes is tough. So the reality is like a lot of coaches don't get into they start a business not to become an accountant, not to become their tax manager, you know, not even to become a CFO, right? Like it's almost like it's just it comes with being a business owner, right? You have to do it. So either you learn how to do it on your own through these resources like we're talking about, or you find a professional to help with you, because reality is it takes a lot of time to understand this stuff, as you know, because you have an interest in it. Like you don't learn this overnight. There's just you're constant, like you have to really have a passion for learning it.
mhm. Absolutely. Yeah, I agree. I think it's good to have a general knowledge and understanding how it all works. But
Mhm.
again, the technicalities and stuff is just much more better to just outsource that stuff. But yeah, psychology of money is really great, man. There's two key points that stood out to me. One was that, you know, no one ever looks at the driver in the Lambo. They're just like looking at the Lambo, envisioning themselves in it too. So it's like it's
Right.
almost like, what's the point? And then the second one was, I loved what he talked about, talking about, you know, optimal strategies versus reasonable strategies. How he said
Mm.
it probably wasn't the most optimal to buy his house in cash, but for him, it's, you know, he wanted to, like, it makes him
Yeah.
happy. You know, there's a level of happiness, there's a level of security there. And so even though it doesn't make sense, for him, it was reasonable. And I thought that was really, really, really awesome.
No, yeah, I love that book, and I love reading. I read a lot of books that are similar to that from like behavioral finance experts, and the reason is because what I do is I work with humans, right? So
Mhm.
I can, you know, you just kind of explained it great with the optimal versus reasonable. Like I can't always give people optimal strategies because that goes against their human nature, right? Like
Mhm.
that goes against the feelings they're having around money. Like if they come to me and they're, you know, like super anxious with money, then I can't be like, you know, go invest in the stock market right away, right? Like I have to bridge that gap. I have to educate them, but I also have to bring them along. And then I have to figure out like, what is not the most optimal strategy in general, but what is the most optimal strategy for their personality, right? Because one thing that we haven't really talked about, and we should because it ties into investing, is your capacity to take risk. A lot of people think just because you're an entrepreneur, you might have like a very high capacity to take risk, but it's not always true when it comes to investing. Like there's just two different types of risk. And so I see both ends of this, right? I see the entrepreneur coaches that like they want all the risk. They don't even want to talk to me because I'm not like touching the risky stuff because I honestly I really can't touch a lot of that stuff. But then it's like the other extreme end is like they built this great business. They took this massive risk to start the business, but they're so scared to do anything with their money because they just don't know what to do.
Mhm.
So there's the risk capacity, and then there's what's called risk tolerance, right? What can they like sleep at night knowing that their accounts are going up and down doing? And you have to really take those into consideration when you're considering how to invest your money.
Yeah, I would say I'm somewhere in the middle. I'm pretty conservative when it comes to saving and investing, and I also have a pretty high risk tolerance. Like I've been dollar cost averaging in like the big crypto, like Bitcoin, Ethereum, and when they go up and down, I don't even think twice about it, just because I have such a long term focus, and I'm like,
Exactly.
everything's gonna go up eventually, even with the short term dips. It's we're all gonna rise.
And
Um,
that's exactly how you should look at it. But a lot of people don't, right? Like they can't handle those dips. And so if they can't handle dips, then crypto is not for them, right? Because there's
yeah,
a lot of up and down in crypto. And I'm not opposed to crypto. You know, I personally have some. I have clients who have some. I don't manage crypto or anything like that, but I'm not opposed to people who invest in it. And you just use the word dollar cost averages. So I want to explain that a little bit. What that means basically is you just you consistently buy in over time. So for example, $100 every month. When you just buy then automatically and you don't worry about what the price is, your dollar cost averaging into the account rather than like waiting for the price to drop and putting in $1,200 a year.
Yeah. What I do every month, I used to, so like I mentioned, back when I was younger, I used to like try to live off as little as possible and invest as much as I possibly can. As I've gotten older, I've learned to put more into my business first and save a little bit less. I have a pretty big nest egg now to where I don't need to save as like much.
Sure.
But essentially what I do is I just round my accounts to the nearest 5 at the end of the month. Right. And
Nice.
so if I, let's say for a beginning coach, let's say you made like $7,800, I would just take $300, round it to the nearest 5 and just save that. Right?
Gotcha.
And that's what I do. But in like with the thousands, like I'll just round it to the nearest 1,000. And then, so each month I'm saving anywhere between $1,000 to $4,000. I just put it away, forget about it, and then just consistently chip away and let the account grow over time.
Yeah. Another way to do it is like set a predetermined percentage. So because, revenue is so variable for coaches, right? And rather than say like, oh, I'm going to save, $1,000 each month because you don't really know what you're going to make. If you say I'm going to save 10%, 15%, 20% each month. So whether it's you make 5,000 this month or 10,000, you save the percentage. With obviously there's got to be a ceiling on it where like you have to like probably cover your expenses, like if you have a really bad month. But other than that, if you just go with a percentage, then the other thing you're doing is you're keeping up with like, have you ever heard the term lifestyle creep?
Oh yeah. It's when your living expenses slowly rise with you making income, correct?
It's human nature, right? So we start making more money, we start spending more money. I hear it all the time. I see it all the time. But when you start working with percentages, right? You automatically, when you make 10,000 a month compared to 5,000, the percentage, you're going to save a higher dollar amount, right? So you're not as likely to fall victim to lifestyle creep as you would be if you say you were just doing $100 a month, right? Because $100 a month when you're making 5,000, okay, fine. But when you're making 10,000, like you probably should have doubled it. I mean, we're talking, honestly, you should be saving more than that at 10,000 anyways, but you kind of get the point. A percentage will always increase as your revenue increases.
I like that. Well, I'm going to switch it.
It's kind of like the profit first system. You know what I mean?
Yeah.
Like profit first tells you what you're going to do with your money beforehand. And I just like to do that as much as possible, put a system in place, because I like to eliminate like decision making, right? Because we're humans. And if I wait until the money's in my account to then decide like, okay, well, now I've got all these competing priorities, but if I had it set up to automatically just put 20% aside, now I see what's left over. I see the 80% and I'm like, okay, what can I spend out of that? Right.
Yeah. I like that. Well, we're running out of time. I want to give you an opportunity to share what you do, how you can help, and also talk about your podcast as well. And then
awesome.
Go over any final thoughts that you want to leave the listeners.
Yeah, cool. No, I appreciate it. This has been a lot of fun. So you could learn more about me. Instagram is my main platform, at Justin Green FP, as in financial planner. And you can tune into the podcast. We don't really, I know it's called Dollars and Dumbbells. We'll dive into the numbers a little bit, but it's not as much about the numbers as people think. I'm just interviewing successful fitness coaches and entrepreneurs. So if anyone listening to this is interested in coming on, being a guest, just shoot me a DM. Love to have you. I just love connecting with as many coaches in the community as possible and learning more about kind of their journey to becoming business owners and how they've become successful. And then shameless plug, if you really enjoyed this conversation and you actually enjoy this stuff, then I'm putting together an ebook that's coming out here soon. So if you want to be one of the first ones to receive that, then hop on my email list now, because they're going to be the first ones to have access to that. So just go onto my website, assistfp.com. And then when it pops up to join the newsletter, just hop on that. It's a weekly newsletter highlighting the podcast. And I give a couple motivational quote, and then, a piece of content I've been consuming that's good for coaches, and a little update on my personal side. Cause at the end the day, I like to let everyone know, like, I'm a human, right? I'm not a spreadsheet. Like a lot of financial planners, we get this bad rep that we're just like these spreadsheets and, we're boring. I am boring. I am boring. I shouldn't say that. But I'm a human at that. So, check that out. And then you'll be the first one to receive that ebook when it drops, and it should be ready in probably 2 to 3 weeks.
Awesome, man. That's really, really awesome. Now, what final words of advice would you give business owners before hopping off?
I would say if there's one thing you took away from this, separate your business and personal accounts. It's step one. It sets everything up for success. Do that, and then start diving into how to save more, how to put money aside for taxes, but separate your accounts. It's like literally, it's the main thing you got to do to start.
Awesome. Justin, thank you so much for hopping on. We'll catch you guys.
Thanks for having me, Zach. I appreciate it.